The stock market can be a fantastic tool for building wealth, especially in the long term. However, making effective investment decisions heavily relies on possessing a solid set of beliefs-based in fact. If you're not careful, there are some widely circulated stock market investing myths that can hinder your ability to become a successful investor if you adhere to them. Welcome to the Seth Brain Money Guide, where we discuss ways to help make money work for you, instead of you working for money. Today, we're going to debunk 10 stock market investing myths that can have a significant impact on your investment goals. But before we continue, please be sure to click the subscribe button. Also, don't forget to tap that bell button so you can get notified when we upload new content. There will be many videos covering a wide variety of financial topics in the future, and we don't want you to miss a thing. Keep in mind that we are not financial advisors. We are just sharing our informed opinions about financial topics with no guarantee of gains or losses on any investments. Make sure you always consult a professional financial advisor before making any major financial decisions. With that said, let's get started. Myth number 1. Big cap stocks are a better investment than small cap stocks. The financial news media primarily focuses on the largest stocks. You'll hear an awful lot about Apple and Google. This is done to make stock investing information more easily accessible to the common everyday investor. For instance, everyone has heard of Microsoft. Out of necessity, the most prominent investors in the world also focus on larger stocks. They have so much money available to invest that they have little choice. Warren Buffett invests hundreds of billions of dollars. Small cap stocks simply will not work for him. There's simply too much money to invest in that way. Try to remain open to all investing opportunities available to you. From 1926 to today, small cap stocks have consistently beaten large cap stocks 11.9% versus 9.8% in annual return. Myth number 2. The S&P 500 is easy to beat. If you don't have a whole lot of time for investing, an index fund is hard to beat. Very few non-index mutual funds are able to beat the market on a regular basis, even though those funds are managed by professionals. Over the long term, the average non-index mutual fund investor earns less than half the return of the S&P 500. If you are too busy in your life to manage your investment portfolio so that it earns as much as possible, consider investing in an index fund. Myth number 3. Timing the market is a great way to improve returns. This would actually be true if it could be done effectively. Regrettably, this seldom ever happens, and it is not a recommended investment strategy. Myth number 4. The ideal time to buy a stock is when it has dropped substantially in price. A stock that has lost considerable value isn't always a good buy. The fact that a stock price has fallen is not necessarily an indicator that the stock can't fall any further. The price of a stock can still drop to zero. Do some basic research and determine why the stock price dropped. If you believe the stock price will rise again, explain your reasoning clearly based on the facts available. Conversely, just because a stock price is rising, that doesn't necessarily mean it's a good stock to buy. Is the stock price rising for a good reason that indicates healthy long-term profits? Can you expect the stock to continue to rise? Myth number 5. You only need a little bit of knowledge to do well in the stock market. For many things in life, a little knowledge is better than no knowledge at all. However, in the stock market, a lack of knowledge can be a huge risk. It can lead to overconfidence, which can then lead to poor decisions. A reasonably high level of knowledge and understanding can help you perform as well as the best amateur investors. You don't have to be an expert on every type of company. However, you can become well-versed on a particular industry. Doing your homework can be very rewarding. Myth number 6. You have to take your profits to be successful. Many investors insist on selling and taking profits when a certain amount of profit is attained. There are 2 problems with using this strategy. The first problem is that there is no limit to how high a stock price can climb. If you go ahead and take a 20% profit, you completely eliminate the possibility of ever making a 1,000% profit, or possibly even more. The second problem is that taxes inhibit future gains. Every time you take a profit, the government takes its share. That means you will be left with less money to invest in the future. There are some key advantages to keep holding on to a stock. Myth number 7. High diversification is important. A lot of famous investors have made comments that you need to diversify if you don't really know what you're doing. It is certainly true that diversification helps minimize your losses. When a certain group of stocks fall, others might rise. This is a great strategy when one of your stocks drops drastically. However, it also works the other way. When a certain group of stocks rise, others might fall. So profits are limited just the same way losses are limited. High-profile investors have suggested that just a few stocks are all you really need. While dropping all of your money into a single stock is foolish, over-diversifying can be just as foolish. Myth number 8, the stock market can only do well in strong economies. You don't need to be able to forecast economic conditions in order to invest successfully in the stock market. Most studies show little correlation between economic growth and stock market performance. Don't let a bad economy dissuade you from being in the market. Even during periods of recession, stocks in the United States still earn an average of nearly 10%. Staying out of the stock market when the economy is performing poorly is almost certainly an expensive mistake. Myth number 9, bonds are not as volatile as stocks. While this is true over the short term, over the long term bond returns are actually more volatile than stock returns. If you compare 10-year treasuries and the S&P 500, it's not even close. The standard deviation for treasuries has been 2.52%, but has been 1.58% for the S&P 500. These are the 30-year rolling averages since 1928. Over long periods of time, stock returns are much less volatile than bonds. If you are investing for the long term, put your focus on stock investments. Myth number 10, good companies always make good stock picks. Microsoft is an excellent example of this myth. The price of the stock fell 37% between 2000 and 2013. The stock has performed badly even though the company revenues increased over 3 times and earnings increased at 2.5 times the rate of the S&P 500. The fact is that in the year 2000, Microsoft was simply overvalued. Contrary to popular belief, studies have shown that the least favored stocks generally outperform the most preferred stocks. By discarding these stock market investing myths, you will be able to make smarter investment decisions which will result in higher profits. Well, we hope you enjoyed today's video. So how many of these stock market investing myths did you believe? Do you still believe them, or have you changed your mind? Or do you feel like you need to do more research? What other stock market investing myths have you heard about? Comment below and let us know. Also, please subscribe to the channel and stay tuned in the future as we will have more great videos highlighting other ways to help increase your wealth and attain financial freedom. We'll see you next time, and as always, take care.